We're starting with big news coming in early this morning. India's sovereign rating has been upgraded by Moody's for the first time since 2004. Coming against the backdrop of lots of concerns in India, this, Neeraj, good morning to you, is the best news that the government could wake up to.
Yeah, and this is the best news that the markets could wake up to. Sorry, I'm a slave for the markets, but I'm guessing across the board, Ida, all asset classes will react to this piece of news. But this is big, not just from a historic perspective, as you mentioned, 2004, but I think coming on the drops of a lot of question marks about what's happening to the health, the fisc, etc. This is a big vote of confidence by the rating agency.
This is huge. This is really huge. It's not just an outlook change, it is a rating change. And we're going to put up some of the details that Moody's put out in their release this morning. So firstly, we were at the lowest investment grade. The last rating upgrade that we got from Moody's had put us at the lowest investment grade. We are now one level above that. This is the outlook on the rating. The rating is Baa2 now from Baa3. So as I said, we were at the lowest of the rating category, the investment grade category. We are now one notch above that at Baa2. The outlook on this rating is stable, which is the way it moves. You move from one rating category to another. You have a stable rating, and as things progress, you either move towards a negative rating or a positive rating. But important this morning to understand why Moody's has done this. So let's put up some of the key rationales that Moody's is putting out in their particular release. I think one of the things that they talk about is the structural reforms that India has undertaken. Among those structural reforms, obviously, is GST. They talk about the fact that the goods and services tax is going to improve efficiencies in the economy. It will also reduce the informal sector, which will then eventually expand the tax base. They also talk about the measures that have been put in place to address non-performing assets. That was a big overhang for rating agencies. And now that the government is committed to a substantial 2.11 lakh crore package for bank recapitalization, the rating agencies, or at least Moody's, is acknowledging that. They talk about other positives, and that is the shift to the formal economy, which will happen as a consequence of GST. But some of the other things that they're talking about is the new monetary policy framework. They're referring to the inflation targeting framework that has been put in place. They talk about direct benefit transfers as well as another factor that is all going to come together to improve India's long-term growth potential. And in that context, let's put up one of those big quotes from Moody's, which is telling you exactly why they have done this. They're explaining their rationale on it. They say that the decision to upgrade the rating is underpinned by Moody's expectation that continued progress on economic and institutional reform will over time enhance India's growth potential and its large and stable financing base for government debt, and will continue and will contribute to a gradual decline in the general government debt burden over the medium term. Essentially, Neeraj, they're saying that we know, and they acknowledge in their release, that there is some short-term weakness on growth, but they seem convinced that all of these measures, when they come together and when they stabilize, will add to India's growth potential over the long term. Added growth potential means added tax revenues, means better ability to service debt, perhaps a reduced fiscal deficit. So they are focusing on that medium term in this rating upgrade, even though, as you said, short term there have been concerns.
So now, Ida, I'm just trying to break it down for the benefit of a lot of viewers who are tuning in right now. What does this mean for different asset classes? We'll get to equity. We get in Mahesh Patel, Vikas Khemani, and a bunch of other voices. But firstly, the debt markets, the yields, etc. What would this move mean for each of these?
Let's start looking at them. So I think the SGX Nifty would have reacted, so we can pull that up. I know that the currency markets in the NDF market, which trades out of Singapore, that has already reacted. So the rupee has appreciated significantly. That's your SGX Nifty. So it's showing you a nice 1% bump up on open. And if you bring up the NDF chart, that will show you an appreciation in the rupee. Essentially, what do upgrades do? Upgrades just send a message to foreign investors that this country and its growth potential, its business potential has improved. So it has to translate into greater fund flows. The immediate is capital flows. So you tend to see some of the pension funds, etc., which are very heavily mapped to ratings, which have investments, mandated in various rating buckets. So those pension funds potentially can, increase some of their allocation to countries like India. So, the first reaction is always sentimental. It's not like you're going to suddenly get, $5 billion in inflows into the Indian markets.
Yes.
But the first reaction is sentimental. But the second reaction, or the second fallout, is in terms of actual capital flows potentially increasing into Indian assets. And the third, slightly more medium to long long-term fallout is that you see foreign investors, longer-term investors look at India a little bit more favorably. And remember, we've had, an improvement in the ease of doing business as well. So when longer-term foreign investors look at that, they look at a higher rating, perhaps, they will be a little bit more comfortable about coming into India.
And they look at the slew of reforms, so to say, which have been done. I mean, maybe this is part in that, but for all the teething problems that it has, we have a GST in place.
Yeah.
There is a PSU bank recap plan which has been put into place, and that should reduce the risk premium naturally from perspective of an equity investor. Now, I want to break it apart into two parts. One is, and I want to ask a question to Ira on the debt fund flows as well. By the way, I think Jayesh Mehta is with us, Ira. So let's just actually first set of questions to him on this.
Absolutely. Jayesh Mehta, Bank of America, Merrill Lynch, joining us. Good morning, sir. We woke up to this slightly surprising but very welcome news. Your thoughts, sir, initially on the rating upgrade? Were you anticipating it?
No, definitely people were expecting it. Timing-wise, yes, it's a very surprise and pleasant morning.
What do you see? How do you see the markets reacting back home, sir? Bonds, currency, I see in the NDF market, the rupee has appreciated already, sir.
Yeah, so I think rupee definitely will get appreciated in the short run. Bond also will play very well. I think we were on the oversold, overstretched strategy 705 as it is. And I think complete discomfort, there were people who have the rate hike cycle and fiscal deficit people were not confident about. I think this will put a lot of pressure on government now not to budge out of fiscal deficit target, right? So I think that should be more or less done. But more importantly, investors, on the rating-wise, existing investors, their capacity can increase. Plus, we will definitely have new investors both in fixed income and in equity. And therefore, I think structurally, we may see the initial rally today and may have some profit booking in the next couple of days. But I think sustainably in next few days, fixed income will be restricted because of the limit thing. But offshore bonds, dollar bonds, their pricing was already on one notch higher. We need to see how they react. But equity flows, I think, will continue, and I think we'll look at big, particularly equity flows coming in the next couple of months.
Yeah, yet another important voice joining in this discussion along with Jayesh Mehta. Mahesh Patil of Birla Sun Life joins us right now on the show. Mahesh, good morning. Thanks so much for joining in. Domestic investors have been proven right this time around in a big way. You guys have been participating. FIs have been missing out. This upgrade tends to vindicate that belief, one. But my question to you would be more important in terms of the structural change that this brings about in the outlook towards India. What is your initial thought?
Yeah, I think it's a big development and something which was awaited. I think we have seen India's macroeconomic fundamentals improve over the last few years. And I think the slew of reforms, what we have seen, I think market has been kind of rewarding that. We have seen the equity markets do well. But I think an endorsement by a world rating agency gives confidence to a lot of foreign investors who have actually not participated in this rally year till date. We have seen FII flows have been negative. I think this can turn the tide around. You would see larger participation from a wider range of investors now looking at India. And over a period of time, India's weightage in the MSCI, on the MSCI funds, emerging market fund weightage had come down. So I think you could see a reversal of that tide. And more importantly, I think a lot of long-term investors who've been waiting on the sidelines, wanting to come into India, I think they can take a slightly longer-term view and look at India despite the high valuations which are there for our markets.
Mr. Jayesh Mehta, just coming back to you for one last question. Sir, there was concern over the last couple of months on the government's finances for this year. Do you think that, taking this rating upgrade into account, the markets will also be a little bit more comfortable, even if the assumption is that you may not meet that 3.2% fiscal deficit number, or does that remain a near-term concern for the bond market, sir?
No, I think though I was not too concerned about it. But definitely, market was looking at that they will breach it out. I would say now, of course, it will give them room to do whatever they feel like. But more importantly, I think this will also put pressure on government. Now that they have got vindicated, it will put a lot of pressure on government not to breach that target.
All right, Mr. Mehta, thank you so much for that.
Yeah, well, that's an important point too. And Mahesh, please come in and tell us what, aside of the fact that what you mentioned at the start of the conversation, that this gets in investors with renewed confidence, what does this do to this whole next 2.5 months of data coming out from the government and moves being taken from the government? Because at a Morgan Stanley conference in Singapore, there was this first small hint that came in from the FM that while the glide path continues, the immediate targets may or may not be met. Does this kind of put that onus on the government that there is an upgrade that has come in? We might as well stick to the target that was promised at the start of the year in the budget.
Yeah, I think that's what the effort of the government has been. I think they have tried to maintain that fiscal discipline, and I think with the objective of trying to get this upgrade, which they were anticipating. And I think more importantly, I think one has to wait and see. I think all the reforms, the GST and big reforms, as they're getting implemented, I think you should see buoyancy in the revenues going forward. I mean, the initial indications, GST tax collections are showing, but it's not very clear in terms of what the net revenues would be. You'll get a clarity of that in the next 1 or 2 months. And looking at least anecdotally better compliance, I think you should see buoyancy in the overall tax revenues, and that should provide government with better fiscal room. And I think while there is a need to give some kind of a stimulus to the economy, the growth is still weak, but I think it's just a transitory phase. You should see growth coming back, and the early indications, if we saw on the corporate numbers in this quarter, is a sign that things are looking to look up for the broader economy as well.
All right, Mahesh Patil, thanks so much for that voice. So we've got two voices in. We've got the bond markets and the currency markets. Jayesh Mehta saying that there will be a reaction, currency already showing it. Mahesh Patil saying he expects fund flows into domestic equity markets to pick up as well. Let's get an economic perspective in. Sonal Verma of Nomura is joining us on the phone line from Singapore. Sonal, very good morning to you. Thanks so much for taking our call. Sonal, what do you make of the economic rationale presented by Moody's in their report? It's interesting that it's coming at a time when all of us domestically were worried about what's going to happen to growth, what's going to happen to fiscal. But these guys, of course, are taking a medium-term view as they would and saying that medium to long-term, all of this is positive, the reforms that is.
Hi, Raya. Good morning. I think, I think most of us post-implementation of GST, bankruptcy reforms, and, now the recapitalization for banking system were generally expecting, positive move on ratings. But the view was that the move would come sometime in 2018 when GST actually leads to more revenue. So the timing of the announcement is clearly a positive surprise. And with this move, actually, Moody's rating is now one notch above both Fitch and S&P. So Moody's has clearly taken a forward-looking view that these reforms will lift India's growth potential over a period of time, will lead to more revenues. And, one of the key constraints that they've always highlighted that India's government debt to GDP at, above 65% versus BAA median of, between 40 to 45% has been highlighted as a big constraint. But they have taken a view that the reforms implemented would take care of, any negative spillovers from higher debt to GDP ratio. So it's clearly a forward-looking view, and the timing of the announcement is a positive surprise.
Exactly, Sonal. That debt point was a little confusing because, that's what they have hammered in for the last few sort of releases, that they have said that our debt to GDP is far higher than peer countries. And they acknowledge that even now it's at 68% of GDP in 2016, while the rest of the median was about 44%. How are they anticipating that these reforms will play into that dynamic? They're expecting a widening of the tax base in a considerable fashion. Is that sort of the rationale that they're playing out on?
Yeah, I mean, looking through the, rationale that has been put out, the anticipation is that, GST is going to lead to more revenues over a period of time. B, the implementation of Aadhaar, etc., is also leading to both reduction in some of the leakages on the subsidy side, and also leading to, more tax compliance. The other reforms, on the banking sector side is going to strengthen the balance sheets and, set sort of the foundation for more stronger long-term growth potential, which will have its own positive impact on the economy. So, they seem to have taken the view that these reforms will lead to, some savings on the expenditure front, more tax compliance, more revenue as a share of GDP, higher growth potential, and therefore overall, an improved outlook.
Just one last question. Is there estimation of growth in sync with what you think is going to play out? So I think they're saying 7.5% for next fiscal. I think they, map their fiscal years a little differently. And then they seem to be, as you said, expecting an increase in potential growth rates over a period of time. Is that in sync with what you expect?
Well, I think given the focus on, productivity enhancing reforms, including GST, and given the focus on infrastructure spending, which over a period of time should crowd in private investment and lead to more capital stock, I do think, that from a forward-looking 5-year time frame, India's potential growth should go higher vis-a-vis the last 5-8 years where it's actually gone down. So yes, we do think potential growth in India is going to improve over the next 5 years. And we also believe that cyclically the economy has bottomed out. We are expecting, the GDP numbers that are set to come out in end November to be above 6%. And, obviously the economy it's been a year now since remonetization, as some of the working capital issues with respect to GST get cleared. I think India will see more benefits from this global export upcycle, which currently we have not benefited at all from. So cyclically, we do think economy is headed higher, and over a 5-year time frame, we do think potential should also improve.
Okay, Sonal, lovely to speak to you. Thanks so much for taking the time to speak with us this morning.
Well, a special voice, Nilesh Shah of Kotak AMC joins us right now on the show. Somebody will actually map in all of these 3 elements put together and give us his view. Nilesh, good having you. Thanks for joining in. Your initial thoughts on this, because a lot of voices are saying that while this was anticipated, the timing at which it has come in is a positive surprise.
In a lighter vein, Neeraj, I will say that Moody's have changed his mood and recognized 5,000-year plus track record of India in not delaying or defaulting to any foreigner. But on a serious note, yes, the timing has been slightly surprising. They have ignored rising oil prices. They have not waited for state election results. They have not waited for investment cycle to pick up. They have recognized the effort made by the government in improving ease of doing business, which they believe will ultimately enhance investment. They have recognized government giving mandate to RBI to control inflation, and they believe the inflationary expectations will start coming down. They have recognized the steps taken by government to expand financial base with Jan Dhan bank accounts.
Nilesh, I'll have to interrupt you out here. I'm so sorry, but would want your view. But Arvind Subramanian, I'm told the Chief Economic Advisor is with us, so we'll have to cut across to him. Ira.
Good morning, sir. I guess we just would like to hear your views. This is a long pending upgrade, I guess, at least from the government's perspective. Your thoughts, sir, this morning?
So, first of all, let me say it's a welcome development. I think we would say that it's long overdue. As you know, in the economic survey last year and before, we've always argued that the ratings agencies, especially India, China relative comparison, did not fairly reflect India's underlying macroeconomic strength and reforms. So this is an overdue correction, as it were. I mean, but also it is a recognition of the reforms that have been undertaken. The major GST, the IBC, the recapitalization, the Monetary Policy Committee institution. So I think it's a recognition also of the reforms that have been undertaken. But I would also add that this is not something that ratings don't drive government economic policy. We're going to be, our policy is going to be shaped by our internal objectives on stability, on reform. So while this is welcome, it's long overdue, and government will have to do what it has to do. Thank you very much. Yeah.
All right, Mr. Subramaniam, can I get another question in?
Yeah, sure. One question.
So just on the debt side, sir, because I think they have sort of hammered in the point until now that, the debt to GDP for India is higher than peers. Now they are expecting a steady decline. Can you explain to us whether that is the anticipation of the government and yours as well, and how that would play out? Would it just play out largely through the widening of the tax base, sir?
I think there's, the GST over the long run will definitely widen the tax base. It's going to be a buoyant source of revenue, both by increasing the tax base and by improving compliance. So certainly, I think one can expect the GST to be a source of fiscal stability going forward.
All right, Mr. Subramaniam, thank you so much for taking our call. I know you're rushed between calls from various media houses. That's Arvind Subramaniam saying that very welcome from the government's perspective. And of course, Mr. Subramaniam's document, which is the document that you get before the budget every year. This year in particular, they were arguing for the need for a rating upgrade. There has been a lot of debate on India's rating vis-a-vis other ratings, other country ratings. And the general sense, at least in New Delhi, was that India was long overdue for a rating upgrade too, first time since 2004. So long overdue would be correct. We will keep trying to get more and more reactions, but for those who are joining us right now, just revisiting the news, Baa2 is the new sovereign rating for India. That's one notch upgrade from Baa3. The last time Moody's upgraded India was in 2004. Moody's now has the highest rating of the three major rating agencies, as Sonal Verma was pointing out.
Yeah, but this is so there are two or three important things that I think came out of these discussions. I think Jayesh brought out an important point, that those limits, and I think we were talking about it yesterday, because we are so close to the limits, we don't know how much of a heightened reaction could come in the bond markets. But Ira, the equity markets is a different kettle of fish, right?
There are no limits there.
One, there are no limits there. Two, they've structurally been so underweight for the last almost 3 months, have been FIIs. And I'm not saying for the right or wrong reasons, but DIIs have gotten right. This is a lucky coincidence, let's put it that way. Yeah. But the DIIs have gotten right in terms of the market move this time around. Does this force the FIIs who would depend on a rating agent, on a country's external ratings to put in some money? Now, you don't quite know what's the nature of the flows that come in. Some ETF flows come in by result of certain macro factors. Some funds follow the MSCI benchmarks, etc., so on and so forth. Does this change the flows direction of some foreign institutional investors because of Moody's upgrading India rating? As you said, this is not a change in outlook, which is reasonably big in itself. Yeah. But this is a rating upgrade, which is since 2004 for the first time. So that is the really interesting thing to see. I would probably believe, if not today, then over the course next 2 or 3 days, we'll have one big day of flows coming in. Now, whether that changes the mood or no, that remains to be seen.
Yeah, no, absolutely. I think you're right. And my question to you is exactly that. Where does this start to play? Does it start to play on the ETF flows first? Does that start to become more positive? Is that the first point of impact?
Yeah, so you would, so you would probably presume that flows which are connected to certain themes as opposed to being discretionary would be the first ones to turn around. I dare say, if you saw ever since, Swanand Kelkar of Morgan Stanley pointed this out, and he's a very good pulse on what's happening within the Morgan Stanley emerging flows as well as otherwise. And he said that ever since October 24th or 25th, we started seeing that bit of a turnaround on select days in FI flows as well. So there were discretionary flows which took notice of the PSU Bank recap being done in the first place, because that brought down India's risk premia a slight notch. Now, with this upgrade coming in, there are a bunch of FIIs, non-discretionary, which benchmark countries to ratings, to external, whatever. The ratings would essentially take on all of these things, to MSCI, verdicts that come out, so on and so forth. So there are a bunch of these FIIs which will now necessarily come in as a result of this having happened. How strongly do these flows change is a question mark, because remember, across the board, when we've spoken to a bunch of these foreign brokerages, all of them are saying that India is now not the only option available. Brazil is looking fairly impressive. Malaysia, by virtue of the fact that oil prices have moved up, and it being that one Asian economy which is an oil producer exporter, kind of that attractiveness has gone up. North Korea, I think, to UBS has started looking attractive. So there are a bunch of other Asian and emerging market economies and markets which are looking a lot more attractive than India. So India is not the only fish in the pond. Having said that, because so much of money has flowed out of India in the recent past, and we have this big development that has happened today, it'll be very, very interesting to see what happens. Just one last point here, and that is that the Indian markets have reached these levels of 10,340, 10,400, whatever, primarily on the back of domestic flows. And those will continue. Those will stand vindicated. A bunch of people who've been putting money into mutual funds will now start feeling that, hey, all is hunky-dory. There is no reason to pull money out of domestic flows. So that crutch continues. The fresh inflows that come in, if they do come in the equity markets, that will be the big thing. You know, the only thing that I don't have a handle on, and I think a market guest would be best placed to speak about it. I wish we had Nilesh. We lovely would have been to talk about it, but I'm told he's got a visa appointment and therefore he can't join on the phone right now. But the interesting thing to ask anybody would have been that foreign money which wants to come into India, and I just bring this up from what had happened earlier, wherein equity markets got flows as a result of what was happening in the bond markets. I'm not saying bond markets will attract money because of equity flows, but because foreigners who want to put money into India, and if the bond markets have that limit for which will not take in the money, do they now also resort to the equity markets and try and find pockets of value? Really? There isn't. I'm saying it may not happen. I don't think it will happen. But which is I'm saying, because I don't have a handle on it, I would love to hear from a market voice if this gets in the money which necessarily has to come in because of benchmarks attached to ratings, to come in at these levels as well, these valuations.
I don't know that it'll play out that way. And I think, while we're all excited about this and, it's good news for India as such, the individual dynamics of each of these markets, and you'll know the dynamics of the equity markets, you've been talking about valuations, etc. If you look at the dynamics of the bond market domestically, irrespective of this, we are now moving into a rising interest rate scenario.
Yes.
Right? I mean, very few people in the market expect an RBI rate cut. Even if an RBI rate cut happens, it may not have a material impact in terms of actual market rates, because liquidity is tightening, inflation is starting to rise, fiscal for this year is not looking particularly great. So there are two views. One is that as people who have been in the market, we were talking about this yesterday as well, will want to book profits because bond prices are coming down, yields are going up. So they'll want to book in their profits and get out perhaps. But then as yields start to move higher, it becomes more attractive, right? So the new flow will come back in. So I think in the bond markets, that sort of dynamic will play itself out independent of a rating upgrade or a rating change.
Right.
Will this attract more money? I don't know. So it can't come into the sovereign bonds because that limit is taken up. It can perhaps come into if they're getting really excited, it can come into state bonds where there is a limit. It can come into corporate bonds, has a little bit of limit. But as Jayesh was saying, you could also see an impact on for Indians raising money abroad.
Abroad, yes.
Because there your pricing becomes more attractive. So there are various ways that the foreign money will or will not come in. We'll see how it plays out.
These controls get extinguished at the end of the calendar year? Do new limits set in the calendar year?
Yeah, they up a quarter. There's a quarterly up increase. So I think I don't remember the exact terminal date, but I think the idea is to move to 5% of the total outstanding, allow foreigners to hold 5% of the total outstanding bonds. That was a medium-term roadmap which had been laid down under Raghuram Rajan. So that upgrades, I think, periodically. I think it's a quarterly upgrade that comes in. But I think sovereign bonds, in any case, people will come into sovereign bonds. Now, if they can't come into sovereign bonds, will they go into proxies, perhaps via NBFCs, etc. in the equity? I don't have the answer to that, but it's an interesting point. Perhaps we will speak to other people and see what they have to say. I think there are comments coming in from the various Twitter handles of government officials as they wake up to this news. There's comments coming in from Hasmukh Adhya. I think everybody in the government today will have a lovely long celebratory breakfast, I presume, because it's been so long, and I know I'm repeating myself, but every time these rating officials have come down to the capital, and they come down periodically to meet with the government to understand what is happening in terms of policies, etc., the government makes a strong pitch for a rating upgrade, and for the last few years, they have most certainly been disappointed. This time around, Moody's has actually bitten, into that argument and upgraded rating. I have to say, Neeraj, and this is perhaps not the time, and we will write out a well thought out piece on the economic rationale of Moody's. But there are holes there. I'm sorry to say. I know you're going to say you find something negative to say in every environment, but it's my job to look at what they're saying. Yes, the structural reforms are there, but this was the same question we asked with the change in the business, the business conditions World Bank Index, ease of doing business index. Is that are you looking at just the fact that these reforms have been announced, or are you looking at what the actual impact of these reforms is going to be? Which is exactly what Sonal was saying. They were expecting this upgrade to come in 2018 when it was clearer what impact, say, a GST, etc. was having, how well the bankruptcy code was working, what you did in terms of public sector banks beyond the recapitalization. In 2018, by about mid-2018, you would have had a clear sense of what is it translating into. One would assume, and we'll speak to the Moody's guys, one would assume it would have been ideal to wait until then before you actually do the rating upgrade. But they seem to have, taken a leap of faith and said that we are convinced that all of this, just the fact that it's been announced, will make a material impact to India's potential growth and tax base, and will have a positive impact. The other thing, of course, is that the debt to GDP ratio. That question I was asking both Sonal and Mr. Jayesh Mehta as well. Moody's and all rating agencies have hammered this point for years, that India is not eligible for a rating upgrade because its debt to GDP is far higher than peer nations. That hasn't changed. That hasn't changed. So what are they saying? I really don't understand how they're thinking this through. Are they saying that our debt to GDP is going to come down from 68% in 2016 to closer to 44%, which is the median for this rating class? That's a huge change. How is that going to happen? Simply by the widening of the tax base, which we don't know whether it's happening or not? So, like I said, they've taken a leap of faith and they will put questions.
As everybody's been saying, it's a forward view that Moody's seems to have taken.
100%.
It's something that we don't expect or don't see rating agencies do too often, right? At least to the best of my knowledge, I haven't seen rating agencies come out and take such a forward view. But it's interesting. We'll talk to the Moody's guys and get to know about it.
At a more informal level. Okay, sorry, we've got some...
No, this Hasma Adya's Twitter handle, Ida, you were referring to this. And just a few bits. No, don't look at the ones on September 8th, but just the 8 minutes ago, Hasmukh Adya is saying 3 tweets that Moody's upgrade of India rating, the path that the government has chosen for long-term reforms and fiscal consolidation is well recognized by investors already. What Moody's is doing formally, confirming it formally, is welcome. Well, that's a very interesting set of tweets given out by Hasmukh Adya as well.
Yeah, I was giving you a little bit of sort of, well, I don't want to call it gossip, but just the informal understanding on the rating picture. So it has always been believed that S&P is the toughest on India and Moody's is the easiest on India. Okay. So we just got to see whether S&P and Fitch also follow through on this or not. Yeah. Moody's typically tends to lead. They sort of are a little bit more ahead of the curve in terms of making these changes. And then S&P is usually the most cautious and follows towards the end. But it will be very interesting to see if S&P and Fitch also add to this square of optimism in India. That will sort of complete the picture. Yeah. So, well, let's wait and watch. Just a brief mention for people who are tuning in right now. You, of course, seen those flashes on the screen and seen the topic that Moody's upgraded India outlook to stable, and that is the really interesting bit. We'll be getting in the Moody's spokesperson any minute, I'm guessing, from Singapore. So that is something that you need to keep an eye out for. But the point is, what does this do to different asset classes as well? Again, it's a difficult call. Actually, maybe it's an easy call to make, that that all asset classes will react positively to this. How positive is the question? Now, Jayesh Mehta, who joined in at about 8 a.m. A lot of you are tuning in right now wouldn't know this, but when he tuned in when he came in at 8 a.m. or 8:05 a.m., he spoke about how the limits, and Ira has been talking about it as well. There are some certain limits in the bond markets which can't be extinguished, and therefore the flows
will not come in a wave. If they were supposed to come in a giant wave, may not come in a giant wave in the bond markets. But the equity markets are a different kettle of fish for two reasons. One, on the cash side, the FIs have been net sellers for a really long time now. But even in the derivative markets, FIs are net short in the derivatives market. And I think that adds a very interesting perspective to what the markets do today. Keep in mind, we've had a 1% rally yesterday, a bit of short covering led rally. We'll have a start which is a big green, about 1%, and you may well argue that this may be deceptive. I would really be surprised if our markets only rise about 0.75%. You would probably presume that there will be more in store towards the course of the latter half of trade. My gut feel, now I'm liable to be wrong, but I would presume that is what could happen. But the key is that because of the short positions existing in the derivatives market from the FI side, does this 2 days move and this rating upgrade kind of changes that?
All right, Neeraj, let's get to the conversation that's most important this morning, and that is with Moody's. Marie Duron, Associate Managing Director, Sovereign Risk Group at Moody's Investor Services, joining us from Singapore this morning. Marie, very good morning to you. Thanks so much for taking the time to speak with us. Can I just first request you, I know we've read through the release, but can I request you to highlight the rationale behind this rating upgrade? We've been speaking to a bunch of people, all of whom said that yes, this was anticipated, but perhaps people would have expected rating agencies to wait until next year when the impact of all these reforms was a little clearer.
Yes, thank you. So we've upgraded India's rating to Baa2 and changed the outlook to stable. And that reflects our vision that over time, the reforms that have been implemented, are being implemented, will support India's economic strength and shock absorption capacity. And with that and a large domestic financing base for the government's debt, then we see stability here in India's credit metrics at a Baa2 level.
Marie, let me just pick on a couple of points. So one is, the increase in the potential growth rate for the Indian economy. Is there any sense, are there any estimates at your end suggesting firstly, what was our potential growth rate after all of these measures were implemented? There's a healthy debate back home that potential growth rate may have actually come down. And then how you see it moving from here on. You've talked about 7.5%, I think, next year growth. But do you expect that our potential growth rate is going to move higher as well over the next 2 to 3 years?
Yeah, so we think really the impact of reforms on the economy's potential will materialize over time, and it will take several years really for that to come through. That's related to the breadth of the reforms, the complexity of the reforms, whether we're talking about GST that should really enhance productivity, whether we're talking about measures that are aimed at enhancing and fostering greater formalization of the economy, including GST as well, but also measures like direct benefit transfers and demonetization. So all of that will materialize really over a number of years. What is particularly important for India's credit profile is that with a growth sustained at high levels, whether it is 7.5%, 8% in the next few years, then nominal GDP growth will be strong, and that will allow the government debt burden to remain at least stable and potentially even to decline gradually over the next few years.
Marie, did you, I'm sure you did take into account, but how, should we read into your upgrade to suggest that you're not particularly concerned about the short-term fiscal pressures that are building up? GST has caused a fair amount of disruption in terms of the indirect tax revenues. We don't know whether the government will be able to meet this year's numbers. Are you sort of putting that aside as the short-term impact of large disruptive moves?
Mm-hmm. Yeah, so we take into account these disruptions, these short-term effects. We reflect that in our forecast. So we have, for instance, revised our growth forecast for this year down to 6.7% before we expect a pickup next year towards 7.5%. We have also revised our deficit forecast. And so for the general government deficit, we now expect 6.5% of GDP this year, and government debt to rise slightly towards 69% of GDP. This is short-term, and our rating assessment really combines that short-term analysis with the medium-term vision and the medium-term analysis of really where India's credit metrics are going. And these medium-term, we think, prospects are improving and have improved compared to last year or a year ago, whereby we are more confident that even in downside scenarios, general government debt will remain broadly stable. And so that's that stability that we think is consistent environment with a Baa2 rating at this stage.
Two questions, Marie. One, of course, is that, there is a lot of concern about what measures like demonetization and GST have done to the informal sector. And yes, I understand that the eventual goal is to move towards a more formalized economy. But nobody has a clear understanding of whether, the people who are employed in the informal sector will get space in the formal sector, what that means for demand conditions. Did you not think about all that? I mean, does that not concern you?
These are all very valid and good points, and indeed some of these reforms and measures come with negative consequences or pain on the economy, at least in the short term, or certain sectors and parts of the economy. I think what we try to do is really look at the broad picture and how these measures and really the whole range of measures being undertaken combine to support the economy, to support the shock absorption capacity and support the fiscal consolidation. And so we have concluded that overall, really, the direction is moving towards a stronger credit profile for India, and that at this point, the Baa2 rating compared to other sovereigns is warranted, is appropriate.
I have one last question, and this is on the debt to GDP. Now, for the longest time, rating agencies have maintained that India's debt to GDP is higher than peer economies, and you make that point in your release as well. We are still in the 60s as compared to mid-40s for some of the other peer economies. How do you see that number coming down? It's it's very difficult for us to understand how you see the debt to GDP number coming down. Or are you saying that because we have a domestic financing base in place, we can sustain a slightly higher debt to GDP?
Yeah, so in the range of factors that we consider to assess the rating of a given sovereign between economic strength and institutional strength, fiscal strength, and what event risk might disrupt that rating and credit profile, the fiscal aspects are a challenge for India. And as you pointed out, the debt to GDP ratio at 68-69% is relatively higher than amongst other Baa rated credits. We expect that debt ratio to be broadly stable in the next couple of years before it starts declining gradually. And the decline would come from the various measures: GST, improving tax compliance, direct benefit transfers, improving the effectiveness and efficiency of spending, demonetization also contributing towards greater formalization of the economy. And so there are a range of measures that point in the same direction, which is a broadening of the tax base, a better efficiency of government spending that will help fiscal consolidation. One additional point is the FRBM recommendations that were mentioned, that were kind of proposed earlier this year. And we think that if this is implemented, that will really enhance the effectiveness of fiscal policy by providing a clearer and more transparent framework and really anchor that fiscal consolidation over the next few years.
Marie, in what could move the ratings up, I think you guys have given out the release saying that, of course, the basic being that material strengthening in fiscal metrics, but combined with that uptick in the India investment cycle, that's not happened in the first 3 years. And if we look at the scenario of things, if we speak to corporates in India, that may not happen in a bit of a hurry. Is there a pricing in that Moody's has done as to when could this eventually happen? Because the PSU bank recapitalization, which you referred to in your release as well, is probably that one big step that aids that restarting of the investment cycle.
So attached to that Baa2 rating, we have a stable outlook. And with that, we communicate that we see really broadly balanced risks. We do not expect any rating change in the foreseeable future. And we see upside risk as well as downside risk to India's credit profile. The upside risk could come from maybe faster fiscal consolidation than we currently expect. Measures like GST, maybe yielding revenue intake at a faster pace than we currently assume. Conversely, we could be surprised on the downside by some of these the impact of these fiscal consolidation measures, by maybe the progress towards a resolution of bad assets on the banking side. So overall, we do see both upside and downside risk, and conclude that the outlook on this rating is stable.
I'm assuming it's a natural, I don't need to ask this, but still, nevertheless, rising crude oil prices, and if there is a continued spike and the vulnerability of economies like India or other EMs to that, that would be a big factor as well.
So our assumption, baseline assumption as regards oil prices, is that they remain range bound between $40 and $60 per barrel over the next few years. If oil prices were to increase higher, then that would have an impact on India's current account. That would have an impact on India's GDP growth. However, compared to a few years ago, India's external vulnerability has diminished significantly. We've seen a rapid increase in foreign direct investment that more than finances the current account deficit. We've seen a build-up in foreign exchange reserves. And so overall, we think that external vulnerability risks are very low at this point, and somewhat higher oil prices will not detract from that.
Music to the ears, Moody. But really appreciate you taking the time out and joining us today. And thanks for talking to Bloomberg Quint.
Thank you.
All right,
Well,
so
that's the lowdown.
That's the lowdown. That's the explanation. Now, it is all about medium term, as perhaps ratings should be. There will be enough detractors who will say that let's wait and see how this plays out.
Yeah.
But you know, they seem to be convinced. They've done their numbers. You can't take them lightly. They're Moody's.
Yeah, we shouldn't. Yes.
I think the only question that I don't have the answer to is that debt to GDP number, because you know, it's a big drop from 60 odd percent where we are above 60% now to about 40 odd percent. But let's see how that plays out. And of course, you know, as has been pointed out, we've never had a problem financing our deficit. We have a large captive base in India. So yeah.
Yeah, and it was interesting. Their thesis on oil, 40 to 60. They don't seem to be believing that there is a structural move upwards in oil. It will remain range bound. That's also probably music to the ears. By the way, some more comments from government officials as well. Just before we take a very short break, though, we need, or maybe we won't do that, but this is what Piyush Goyal is saying. And reforms like GST and demonetization help improve India's sovereign rating after more than a decade. Yeah, and then he's, of course, put in the key elements, according to him, of what Moody's had to say. He's, of course, talking about how recognizing India's growth-enhancing reforms, Moody's has upgraded the sovereign rating. Entire world is recognizing the motto of the BJP, Sabka Saath, Sabka Vikas, and there are multiple other tweets. So I'm guessing a lot of, I mean, this is a shot in the arm, as Ida was saying, that there should be a party at the government offices today, and not without reason, quite frankly. The first time since 2004, if I'm not wrong, Ida.
First time Moody's has upgraded since 2004. I'm sure we're going to talk about market reaction as we get closer to market opening. So we'll get the market verdict in half an hour.
Yeah, we should be getting it in half an hour, but I think the pre-open rates in 15 minutes should settle that as well. But okay, full tilt towards the day's trade. For now, this is the end of First Word, a very different First Word as we know it. The first time that we've done a First Word like this for 45 minutes, but it deserved a mention. Let's take a quick check of what's happening in the day's trade. The commodity markets, they will play a small part today. It's all about Moody's, yes, I'm sure, and we'll get in our market experts in to talk about all of that as well. Pradeep Johnson to take the show forward, both on the commodity front and, of course, on the equities front. Pradeep, good morning.
Good morning, Neeraj. So it looks like a huge uptick on Nifty. SGX is looking at 10,350 odd levels. And on the commodity front, actually, the upgrade doesn't really affect the global commodities market, but local traders should keep an eye on what's happening to rupee. The NDF that I had checked last is up by around 30-35 paisa. The rupee may open above 65 after falling, yesterday and last 2-3 sessions, actually. So that is going to be the key determinant for commodity prices or commodity markets in India. However, if you just look at it, crude is all set to fall first time in 6 weeks. So that's the kind of trend that we have seen there. If you look at gold, has inched up a little. To talk about other metals, actually, this is the second week of loss for base metals in general. After falling for 3 days, nickel has inched up a bit. But if you look at copper, aluminium, zinc, lead, they're all looking weak. So all in all, base metal is not looking that great, and rupee on the back of this upgrade and also benign commodity prices is all set for kind of a gap up under 65. That is the expectation. That is what forex traders have been telling us so far, Neeraj.
Yeah, so let's wait and watch. But full tilt towards the day's trade. I think we'll get in Chakri Lokpriya in moments from now, and a bit later on a bunch of other expert voices joining in. Just bring up, frankly, what the Asian markets are doing today. It's of little consequence because we will have the SGX Nifty already pointing towards an uptick. And Pradeep, just a thought, there's so much of shorts in the system, at least on the FI side, on the derivatives pocket. I don't know. We're not trying to predict here, but I'll be really surprised. I don't know about you, but I'll be really surprised if we open up about 1%, which the SGX Nifty was anyways indicating, and stay at those levels.
Yeah, so I think shorts will keep supporting actually, and we may try and kind of cross the 10,350. That was an intermediate goal that traders were looking at. So I think we may try and cross that and stay above that level. So look at the kind of swing we have seen. We were below 10,100, and from there, this is a 200 points move if we are at 10,300 at open today. And thereafter, I think short players will not have any excuse really to hang on, and given this kind of a huge leg up for the bulls, I think there's going to be a huge short covering, and that's the story. Let's see if Bank Nifty will actually give us some surprises and hit record levels. That is always possible because Bank Nifty is more crucial here
and fairly resilient. It didn't fall too much on day before yesterday. It's rallied in equal measures tomorrow as well.
And when you try to translate and upgrade into the bottom line, I think it's the financial players who benefit because their cost of capital will probably actually fall if global markets react to it and the bond markets react to it. So in that case, you'll be bullish on Bank Nifty more than on Nifty really. So Bank Nifty is the one to watch out for.
Let's wait and watch for that one. Let's get in our fundamental voice on the show as well. Chakri Lokpriya, Managing Director at TCG Asset Management, joins in. Chakri, what a day to have you. Good morning. Almost everybody that we've spoken to since the morning, Chakri, are saying that this is a positive surprise. It was anticipated, maybe not so quickly. The question now that we have is the resultant impact on all asset classes, all markets, equity markets, bond markets may have a bit of a cap. But what is your thought? And will this be a prolonged impact or will it be a short-lived impact?
This is a great day to be here, and I think we will see a sustained rally in both PSU banks as well as infra companies. For two reasons. One is this is going to sustainably lower the credit costs for banks and PSU banks in particular. And second, all these huge indebted infra companies which have high levels of debt. Now, because of the bank recapitalization program on one side, and now the Moody's upgrade as in addition to that, will help banks to resolve the outstanding, some of the NPL issues, take haircuts, and move on. So these companies, on the other hand, the infra companies, which are in essence the NPLs, or the troubled loans, they will now make a resolution, go out and raise capital. So I think it's hugely positive for both infra as well as banks.
Sorry, the question, Chakri, though, that this upgrade is coming in when we are trading at 10,350 odd for the markets. We are not at cheap valuations. And the earnings cycle, while might just be about turning, we don't know how smoothly and how quickly it will turn around in Q3 and Q4. Does that put a small bit of a lid on the enthusiasm for the near term? I mean, I'm saying had we been at 8,500 on the markets and this upgrade would have come in, it would have been obvious that there is a sustained rally possible. At these levels, purely from an equity market perspective, on a levels mode, how much of a leg up does this give?
Basically, if you look at the previous quarter to the current quarter ongoing, you see there is a revenue acceleration that's happening at the Nifty level as well as at the BSE 500 level.
Yes.
And revenue is up roughly about 10-12%. EPS is up roughly about 13 to 15% versus a decline in the previous quarter because of well-known issues.
Yeah.
So as this trend continues over the next couple of quarters, clearly the multiple comes down. And these are depressed earnings anyway, and looking at PE on a depressed earnings is not the right thing to do, in my opinion, at this point in the economic cycle. And so when you have the ROE of these companies across board, India as a country has come down dramatically from 2007-8 to now. From about 18, 19, 20%, it has come to 13, 14%. So even a marginal uptick in ROEs will have a significant re-rating to multiples. So I do not think this is an expensive market.
But Chakri, you have spent so many years in markets. To what extent do the FIIs investing into equity really look at the ratings? Because we have a rating agency upgrading India, and look at what has happened over the last 6-8 months. FII money has not really been flowing the way it used to flow around a year back.
Yeah, we handle FII money as well, and I think this is a huge positive for FIIs, because as an FII, I also look at the potential impact on the rupee. And this credit upgrade will lead to a strengthening of the rupee versus the dollar, despite rising oil prices. And that translates into incremental higher returns for FIIs. So therefore, I think this is a very good sign for additional FII inflows.
Wow, okay. So, no, I think it's an important point, Pradeep, that you've raised out. Chakri, the only question is, for any FII right now, India is not the only fish in the pond. I mean, yesterday at the UBS conference, they have maintained that for a long time they have been structurally overweight India. It was their favorite market. Now they are moving positions to Brazil, to North Korea. Malaysia has emerged as a favorite because it being an oil exporting nation and oil is at 60, 65, what we may. India is not the only fish in the pond.
Indeed, absolutely right. And Brazil has gone up because the commodities have shown a strengthening cycle. Malaysia for the same reason. And now India people invest for a different reason. India is still primarily a services related market. 63% of the economy is services. So when you come to portfolio allocation from an MSCI perspective, you would look at the services uptick that will help. GST, etc. has resulted in a downtick, but that is transitory. They're doing a lot of repair work, the government, in cutting GST rates, etc. So India's percentage as MSCI basket is at a neutral position right now. So it's not overheated by any stretch statistically. So I think even a couple of percentage shift increase from 14 to 16 over the next 1 year or so will translate into a very big inflow.
Wow. Okay. Since you watch the color of the money so closely, Chakri, would there be funds? I'm guessing the answer is a yes, but I'm just still asking you. Would there be funds that would be investing in countries based on certain benchmarks? One of the benchmarks would be MSCI. One of the benchmarks would be the external ratings of a country. And this having changed forces some money to come into India.
Indeed, absolutely yes, because one of the big trades today that's happening in the US for the US markets is people investing in high yield companies where they expect an upgrade of credit rating of those companies. Therefore, they are become safer credit profiles, which translate into higher stock market returns. So I think the same logic applies to India as a country in terms of the stock market. Because of well-known reasons, economic downturn, companies have not done well, low profit margins. Now, when you have the opposite cycle, translates into higher profits, sustainable profits, translates into higher stock prices.
Mm-hmm. Like you said, the infra companies would probably benefit, the financials would benefit. But if you really look at it, over the last few days, we have seen heavy sell-off in the heavily leveraged companies. Do you think there is really an opportunity here? Do you think there are companies that would actually benefit? Because the view that market has taken is that most of our companies in this sector, which are indebted, which have been in trouble, they probably don't have a chance to kind of turn around, and nobody's betting there.
The very highly the leveraged companies, all the names aside, the Jayaprakash's of the world, those will have a tougher time. But you have enough number of companies who have a fairly high level of leverage, but are manageable levels of leverage. And if that can be brought down, it will translate into sustainably stronger companies. I think so. If you take out the top 15, 20 accounts of highly stressed accounts, there are hundreds of companies out there. So at the aggregate, as these companies re-rate in this infra space, it leads to a sustainable improvement.
Let's get in our derivative expert and our technical experts on board for a quick comment as well. Chakri, stay on, so much more to speak about, but Gaurav Bisa and Jay Thakkar are with us. Gentlemen, 3 minutes to market open. Gaurav, to you first, very quickly. With the index starting off at 10,345 or thereabouts, do you believe there could be more in store? What's a trade that you could take?
Good morning. As I've been mentioning earlier also, that for me, Bank Nifty is a more lucrative trade. So if I get Bank Nifty at around 25,550, I would be a buyer in Bank Nifty. 25,700 is the immediate resistance, so that can be the first target. About 25,700, one can expect 300, 400 points further gain from those levels. So I would be more keenly watching Bank Nifty rather than Nifty. For Nifty, yes, there's a trade till 10,400, 10,420, but I would not be an aggressive buyer or aggressive trader in Nifty.
You would go out and buy the Bank Nifty at open today, Gaurav, irrespective of the level that it starts at. Let's assume it starts off about 1% higher, the Bank Nifty.
No, I would not. I would not be buyer at 25,600, 650. Yes, I would buy a call option if it trades about 25,700. Last two occasions we have seen Bank Nifty reversing from exactly those levels. So that can be a breakout level for Bank Nifty. A strong momentum can be seen. So yes, I would be a buyer in options in Bank Nifty about 25,700.
He's echoing what Pradeep mentioned at the start of the show as well. Jay Thakkar, what would your top trade be today on the key indices? And go with an assumption that we'll start off about 1% higher.
Hi, good morning, Neeraj. Absolutely, that's what SJS Nifty is reflecting, and I would say that 61% of the entire fall which we have seen recently from 10,490 until the yesterday's or day before yesterday's low, I think 61% comes to around 10,354. So if Nifty in today's trading session managed to close about 10,354, would really again indicate that a fresh move on the upside may just start from here on. On the lower side, I would say now that 10,139, 10,214, which was yesterday's close, so maybe below that, I would say there would be a short-term reversal level. Until those levels are not broken, we can safely assume that Nifty might close above the 61.8% retracement. And as Gaurav and Pradeep were also mentioning that yes, Bank Nifty might just play a major role because it has broken out from a bullish flag pattern, has been consolidating within a symmetrical triangle pattern within a range of 25,200 on the lower side to 25,700 on the upside. So we have been mentioning, we have been long, since 25,200 levels got broke on the upside for a target of 26,700. Now that's our medium term call. Now if 25,700 levels get taken off today, then I think it would add on to the momentum for the immediate target of 26,000. And in this expiry, I think in the weekly expiry, that could be the level to watch out for. So if in today's trading session, if Bank Nifty manages to take off 25,700, then my advice to the traders, for the short-term traders, to go long 2600 call option for the weekly expiry. Two buy recommendations which I have are on GNFC and the Dalmia Bharat. I think GNFC is quite likely to inch towards the levels of 474 with a stop loss of 435. One can go long here, and Coromandel as well. I think with a stop loss of 509, one can target 545, 550. Dalmia Bharat can be targeted for 3,100.
Okay, so that's the call actually coming in. Not that the important stocks in news won't be relevant today, but I think markets will focus definitely on the stocks that benefit from the upgrade, and that is going to be from the banking, infrastructure and the other over-leveraged companies, as Chakri was also mentioning. But look at Asian markets. Well, they are not supposed to react to the India-specific news, so they are flat. I think more or less neutral signs for us, I would say. 10,347, that is where SGX Nifty is. So that is where probably the near month futures will open. But look at the price here. In pre-open trade, we have seen that level in cash market, which means futures should open around 40 points above this, near 10,400. That is if these levels really sustain. But I think Nifty will probably decline and it will adjust at a lower level, possibly looking at the SGX number. 10,300, closer to that is the level that we see here now. Let's look at Rupee. Rupee was up 0.5% in NDF. That is what the update came in from Forex traders. Is up 1% actually, 64, and it's quite volatile. Trying to really a price discovery is underway right now, because you don't see it ticking as fast as it is actually in open. It's moving more like the equity market today.
Yeah, but quite frankly, for people who don't understand these markets, the currency market traders would be would really be tight-gutted right now, because that market would be moving with a frenzy. I think we've got a voice as well on the currency markets, but Chakri, just a quick word on the currency as well. This is that initial upgrade. You could pretty much map it on an Excel. The question mark is what next?
As long as the current upgrade, Moody's upgrade, is moved to stable. So as long as we see, and which I think we will, for various companies to refinance their loans and bring down their credit costs, that will translate into a rupee strengthening, that is from 64 moving 63, some number higher. So this path of fiscal consolidation, I think, is a great step for the rupee.
Yeah. But there will also be an important point, even in last month when FIs were not that positive, actually RBI has bought more dollars and kind of tried and not allowed rupee to appreciate. So we are not really worried about depreciation in any case. Now if more funds come in, that means RBI will have to probably buy more dollars, or it will have to allow rupee to appreciate. So that's going to be critical. And from the forex market viewpoint, actually 64.50 odd levels is something that they have kind of protected for a while. So we'll have to see whether RBI allows rupee to appreciate above that. So that is the kind of question every forex trader will have in mind. So we'll pause probably here with 1% uptick that we have seen early in the day, and then wait for a reaction coming from PSU banks and maybe RBI.
Okay, well, that's Pradeep's view. Well, let's wait and watch for that. 64.67. We should get a phone at any moment really on the currency as well. Let's get in a trader or a currency expert to really talk about it as well. But I'm guessing, I think what Chakri and Pradeep mentioned out here is pretty much something that will happen. But this is this is interesting. Bring up the equity markets. Just need to keep on marking what's happening to the Nifty in the pre-open session. Let's bring up what the individual movers are doing as well. So banks should come up on your screen. State Bank of India. I dare say private sector banks too, but more often than not, PSU banks will be the ones that will have a big reaction today. 3.5%, 4%, PNB for about 1.5%. Let's also not. Let's bring up ICICI Bank and Axis Bank and just see what's happening there as well. So those are a few names that are working around. Just a quick thought from Sajal Gupta, Head of Forex and Rates at Edelweiss, joins us right now on the show. Sajal, good morning. Thanks for joining in. What are your thoughts, really? We're starting off about 1% higher, if I'm not wrong, on the rupee. What during the course of the day or over the next few days?
So I think it's a good positive news which we were waiting for long, and I think it came overnight with a bang. And at the most unexpected times when fiscal concerns were there. But I think going forward, this is good for the bond market. We'll see a good softening on the yields, which have already risen to almost 706 seen yesterday closing. So I think yields would be the first one to subside, and we'll see good flows coming on the debt as well as the equity side. So maybe we can see maybe 64.20 or 64.50 on the lower end of the range. And I think that should be it.
That is the realistic assumption, really, to expect more flows into the equity and debt market. But so far as debt markets are concerned, I think there is not much headroom for FIIs to come in. What's your assessment?
For the FIIs perspective, I think still there is some limit available in the corporate bond market as well as the G-Sec. So I think that should be helpful.
Prior to this, Sajal, what was your targets on rupee or a likely range for rupee for December 17 and March 18? And do you think that would meaningfully alter because of this development?
I think yes, in a short term. But in case we see something happening on the Fed side, so our target were primarily close to 66 levels by December and March. And I think that would obviously need to be shifted lower now. Maybe we can look at a new number of maybe 65, 65.5 as a depreciation which we look going forward.
Okay, Sajal. We'll leave it at that. Thanks so much for taking the time out and joining us. In the pre-open rates, in the first 5 minutes, only one small loser, and that's a technology company, not with, no surprise that HCL Tech. No big bang moves, at least until now. Almost all companies rising about 2.5%. It's actually not too bad. And led obviously by the banks and by ONGC, which is up about a couple of percentage points as well. Now the question is, what I think, and we'll get in a brokerage note as well, because I think amidst all of this, CLSA has come out and spoken about the fact, given their India view post their conference as well. Actually, if Darshan is with us, maybe just get in that view as well, because we're talking about this Moody's upgrade. There is something happening beyond the Moody's upgrade as well. There is a new listing on the block today. There's a very important brokerage note. So let's get in Darshan first to speak about the greed and fear note. Darshan?
See, Neeraj, what he says in the greed and fear note, he believes that, globally a possible correction can come in. So he's telling his long-term investors to actually hedge themselves against, a correction that would come in. But that would also provide an opportunity to enter into markets like India and China, which are his two biggest bullish markets at this point of time. The missing link for the Indian story was the PSB Bank recapitalization, and now that has happened, he believes that there is a light at the end of the tunnel, given the fact that there will be significant amount of growth that will come in the banking system. Valuation, no doubt, is expensive. India is trading at almost 18 times on a 12-month forward basis, but at the same time, aggregate corporate profits as a percentage of nominal GDP has fallen from almost 7% to 3%. He believes that growth will definitely come in from here, and because of that, foreigners will be more inclined to buy the India growth story. As far as the model portfolio changes are concerned, he's removed the 4% weightage point from Z Entertainment as well as ACC and given the same to Bharti Airtel as well as Dalmia Bharat. 3 percentage points were also removed from Mashan Iron and Steel and given to Vedanta, and 1% was removed from Maruti and given to Godrej Properties.
Thanks, Darshan, for all these details. So good news coming in from CLSA. What is important, he mentioned that, in fact, the recapitalization of PSU banks has filled the missing link in India's macro story. So this was not really a cause for concern. the way Indian markets, especially the debt markets, were reacting to it. And after this upgrade, you can see the 10-year yield has today declined by 13 basis points. That's a big move from debt market standards. 13 basis points is something that really happens under these kind of extraordinary circumstances. And that is what has happened today. Below 7%, that's a big news. I think we're close to 6.9394. That is the level I saw when I checked for the last time. So Chakri, what you were actually mentioning that the corporate margins are depressed, and that is exactly in different words. CLSA has also mentioned that corporate profit as percentage of GDP have declined.
Indeed.
But do you think over next 12 to 18 months there is a possibility that margins would probably expand and we'll have more normalized level of EPS coming in, and therefore valuations would look much more reasonable?
Even if you look at from the previous quarter to the current ongoing quarter, you have seen that the companies have taken various steps despite an environment of rising commodity and metal costs. So which means input costs for companies have gone up. And interest rates have been where they are. So there's been no change from last quarter to this quarter. In spite of this, there has been a margin improvement because of a marginal improvement in the top line. So as demand improves going forward, this trend will continue, and this therefore improves the profitability, or rather the profit margins, which is what is more important to the stock market. Definitely. Rather than the absolute level.
We
of
asked it because we have been listening to this comment for several years now. For the last 3-4 years, we've been waiting for the margin expansion and the normalization to really happen.
So let's get in the pre-open rates as they have settled now, and you'll get a sense of how the markets have given that initial reaction to this piece of news. So let's just see that. So about 1% higher, 109. But I dare say, I don't know why I get a feeling that we may end the day higher than where we are right now. I may be completely wrong here, by the way. Not trying to predict what the markets would do, but just a sense that maybe, just maybe, there could be some more in store, simply because there are so much short positions piled in the system that may play a part towards the latter half of trade. Keep in mind, the global markets are positive. The global markets are not negative, and that only aids that small bit of sentiment that we'll have today. But let's wait and watch what happens there. As I said, almost all key stocks have started off on a positive note. State Bank of India more so. What would you do, Chakri? Would you go out and buy any of the larger banking names, not just purely as a result of this, but a set of tailwinds now that are coming in for the banking space at large and for the PSUs in particular?
Even if you asked me this question yesterday, I would say go ahead and buy SBI, Union Bank, PSU, L&T, all these companies. And today I'll still stick to the same line, which is because we think these stocks are growing at least 25-30% higher from current levels over the next 12 months. And if you look at a longer time horizon, I think these stocks go much, much higher.
Wow. Yeah, and viewers, mind you, 20-30%, you may see mid-caps moving around like that, but 20-30% in a year is a fairly decent set of returns, and for portfolio managers even more so. But even for a retail investor, 20-30% on a large cap name stable is a really good set of returns that people get in. So, don't take this very, very lightly. But it's 9:10, Pradeep. That time of the show, when we just tell you firstly all that you need to know to stay ahead in trade today. A lot of stock-specific news as well. The biggest is Moody's, of course, but beyond that, CLSA has reject its ex-Japan long-only portfolio. Z Entertainment ACC exit, make way for Bharti Airtel and Dalmia Bharat.
FII limit hiked by RBI in ICICI Lombard, Edelweiss to 49% and Petronet LNG by 40%. So that's the good news for these three stocks.
In earnings today, we have JMT Auto, Kalyani Forge, Mayur Unicoaters and Salzer, which will report numbers in the session today.
In Birla Sun Life, AMC buys into Dixon Technologies, while Old Bridge Capital checks into Tangamail Jewelry. So leg up for these two stocks.
Yes, indeed. 5% up for Tangamail in the session today. HDFC Standard Life to list on the bourses. Base price of 290 rupees per share. Issue subscribed 4.9 times.
And Nomura raises just Dial's price target to 635 rupees from 590 rupees on company's renewed focus on its core search business.
Fair call. Okay, 3 minutes to go before we start trade. Gaurav Bisa, thanks so much for waiting patiently with us today, but it's just been such a busy day, so I hope you understand. Now that you've seen the pre-open rates, what are the stocks that traders can trade in the session today?
The first one would be Apollo Hospital. I think even at these levels, 1025, 1026, I think it's a good level to buy. On the upside, one can expect 1070, 1075 kind of levels in a day or two with a stop loss of 1005. One can buy it. There was 30% over additional short pushes were seen getting built in the last 10-15 days. Yesterday, we saw small short covering coming in. It's a good level to buy. This is one stock that would be in the focus. Mindtree would be another. If it sustains 510, 512 by today closing, then I expect 540 kind of levels coming in. So with a stop loss of 500, one can buy a Mindtree as well.
Picked up last evening based on how the things were then. Today, the first thing anybody would like to buy is a PSU bank. I think SBI will open very close to that 350 mark that has been a resistance for a while. Which one PSU bank will you pick up this morning?
Among the PSU banks, SBI looks good. So any retracement towards 340 today intraday, I think that can be a lucrative level. 335 can be the stop loss. 350 to 53 is the immediate resistance. Above that, it can again see a strong movement going. I would stick to the larger ones, probably Bank of Baroda. After SBI, that looks quite interesting. So that is another name that one can look at it. Bank of India among the mid-cap or small-size PSU banks that is looking quite robust. 215 kind of levels can be possible. So these are a couple of names that one can look at.
Okay, and just before we start trading, Gaurav, very quickly, your trade on the Bank Nifty for everybody who's missed out on it earlier.
Well, I am not somebody who would like to play on a gap up or gap down opening, so I would wait. Any retracements towards 25,700, 750 can be a lucrative buy with a small stop loss of 100 points. One can buy for 26,200 kind of levels or buy a call option for that matter. Do not buy at 25,900. We can see some profit booking in later part of a trading session. Wait for retracements.
So wait for a retracement. Don't buy on a gap up. That's the strategy on Nifty Bank really. Just a few seconds for open, Neeraj.
Yes, indeed. About 35 seconds left for the markets to kickstart trade. So quickly get you the setup. We'll start off on a positive note in the session today. No surprise there, about 1% higher. The question mark is whether we can extend those gains or whether we'll stay put at that 1% mark. That's the key question. Remember, a lot of shorts in the derivatives market on the FI side as well. If those start getting covered, then that could be an interesting move as well. A bunch of reactions that we've gotten already. PMO India's tweets on your screen as well. They've tweeted out about the Moody's upgrade and spoken about how the measures taken will only enhance these moves coming in. But full tilt or full attention on how the markets have started this Friday morning. It's a fantastic Friday, about 1% higher, but the Nifty Bank is the one to notice. 420 points higher, about 1.5%, and no surprise there with what SBI and a few other banks were anyways pointing towards in the pre-open session. Let's get the Nifty heat map. I'm sure the broader markets are doing much better, but let's get the heat map. It's a fair bit of green. The only ones in the red, obviously so, are the technology companies. I tell you, this would be a sentimental reaction though, but it's a 1% strong move on the currency, so you wouldn't be surprised with that bit of a red. 5 names out there, all of them technology names, but look at the green on the screen. The big boy Reliance is up 2.5%. SBI and some of the others are doing rather well for themselves. So let's get these individual names on the screen. Let's get in all the heavyweights. Reliance Industries, ITC, HDFC, each of these names should come up on your screen. SBI up about 3.5%. ICICI Bank, Axis Bank, some of the others should come up on your screen. ITC about 1% higher. This was weighing in, or rather this was participating in the mood yesterday, participating today. ICICI Bank 3% higher, Axis Bank about 1% higher. We should get in HDFC, we should get in Reliance Industries more importantly, because that would be reacting as well, I presume. HDFC Bank is up 1%, HDFC should come up, and then Reliance Industries should come up. HDFC about 2.5% higher, and Reliance I'm guessing should be in the green. I wouldn't be surprised if it is 2.5% higher. Back to its winning ways. Remember, it lost about 7% in the month of November. Clawing back to those levels of 940, 945 is Reliance Industries as well. So good start for almost all the key markets, and the Nifty and the Sensex have only inched up higher now. 410 points for the Sensex, 121 for the Nifty. Pradeep, what else are you spotting?
At the PSU banks, PNB is interestingly once again the stock which has gained most among the prominent PSU banks. This was also the scenario the day recap was announced. So looks like a lot of traders are actually focusing on this one stock. Also among a few other names, you have Shriram Transport Finance and NBFC, which has moved up quite a bit. You have infra names like J Kumar Infra doing well. You have some more NBFCs like JM Financials also moving up. Real estate players like Kolte Patil have also benefited by this upgrade really. You also have Just Dial after that target revised. The stock is up around 3% in today's trade. Rain Industries, after falling for several days, is up 3% as well. So a lot of green in mid-cap and small-cap space as well.
Yeah, okay, just before we get in, another very special guest on the show. Just want to mark the tweets that are coming in from PMO India. And of course, I think the narrative is there on the screen, is saying that Moody's believes that Narendra Modi government's reforms will improve the business climate, enhance productivity, stimulate foreign and domestic investment, and ultimately foster strong and sustainable growth. So that's the tweet that is coming in from PMO India. You would have to say, and I think I'm just quoting Ira's words, that Moody's traditionally has been a lot kinder to India than S&P and Fitch have been. They've taken a leap of faith. It's a forward statement that they've given. It's a forward assessment that they've done. Let's see if the other rating agencies follow suit. But let's right now focus on what this means for different asset classes in the markets. We'll come to the different rating agencies in a bit. Krishna Kumar Karwa, Managing Director at MK Global, joins us right now on the show. Krishna, so good having you. Thanks much for joining in. You couldn't have asked for better news this Friday morning.
Absolutely. I think coming back on the first, you had this ease of doing business ranking moving up. That's a good macro news. And then now you have such a big macro news in terms of the Moody's rating agencies giving a sovereign upgrade to our ratings. I think it's a phenomenal endorsement by global agencies as far as the way India is conducting its reforms. And it will be a very big sentiment booster. And also as far as obviously cost of borrowing for India itself will come down. So that's a very positive sentiment booster. So yes, basically I think it just moves the sentiment up. So we are obviously on a corporate level waiting for earnings to move up, but the global macro news continues to be positive for India specifically.
Normally after such a development, when you interact with equity analysts, they say that we are more forward-looking, and rating agencies come in very late in the game. But this time around, if you see over the last few weeks at least, our own domestic analysts were a lot more concerned about Indian macro. And then this is a surprise upgrade. Do you think this time equity analysts will probably have to sit down and take a note of this and probably revise their forecast upwards?
I agree with you, because if you see, even if in the quarterly results season which came about, you could possibly see that the earnings estimates of most analysts were behind the curve, and the number of upgrades or maintenance. I mean, what we have seen is that there have been a good amount of upgrades as far as earnings estimates for FY18, FY19 has come. So I think analysts have been very conservative and maybe colored by the negatives from demonetization or local GST-led issues. But I think the resilience of corporate India is obviously shown in the kind of performance that many of the corporates have shown in the second quarter. And also now with the global agencies recognizing, analysts will be scrambling to upgrade their price targets and estimates. I think it's a phenomenal move as far as this ratings upgrade is concerned.
Yeah, but to be fair, Pradeep, it's just been such a difficult last 6 or 9 odd months for putting out estimates in the first place. Demonetization, GST, pre and post both. Just being fair to the sell side, that it's just been a very, very difficult last 9 months to be putting out earnings estimates. But one thing where I think I take on board both your points is the fact that the earnings cycle uptick that Chakri was referring to earlier too could just be starting, because we've had a very good quarter too. Now, the question to Krishna is coming on perched as we may be at near all-time high levels. The fact that the earnings did look fairly impressive in quarter two, and we have a tailwind of fundamental macro checks that the government has put into place, recognized by an external rating agencies as well. Would you presume that multiples could move up higher? One thing is the earnings moving up higher, which they inevitably will in quarter three and quarter four, but the multiples that could move in higher, and therefore that could make way for the markets to clock in further higher levels. Is that a possibility, Krishna?
So as far as multiples moving higher, I would be very circumspect, because at the end of the day, we are trading at reasonably high multiples, maybe 4, 5, 7-year highs as far as multiples are concerned. So it's the earnings which will have to follow. So what possibly you are going to see is that you would see earnings improving, and maybe the multiples will contract based on how the earnings move up, rather than expecting multiples to move up. I am not expecting multiples to move up further, because we are already at an elevated level. So valuations are what we have to be cautious and careful about it.
So let me rephrase my question. I didn't mean that the P multiples of the markets per se would move up, but the expected P multiples in the minds of people of what is fair value. Will that move up a notch? If you expected 16 times to be fair value, while the market may be at 22, would you now expect 18 times to be fair value or 19 times to be fair, whatever?
I think with the bond yields also, or the GSEC yields also having moved up to 7.705, and with credit cycle expected to pick up, possibly we will see the we expect that the GSEC yields to move up to 7.5, 7.7 in the next 6 to 8 months. I think this is a constraining factor as far as PE multiples to move up, and for investors to value stocks on a higher PE multiple and look to invest. So what is going to possibly happen is that investors will look to invest in stocks where valuations are in their favor or valuations are reasonable. That is what's going to drive the market. Ultimately, these important macro news are very good and they help the country or the stocks in a longer term. But 2 weeks from now, again, we will start talking on how corporate earnings are or how corporate individual bottom-up stock performances are.
Okay. More questions to both Krishna Kumar Karwa and Chakri Lokpriya, but I'm told the Chairman and Managing Director of HPCL, Mr. M.K. Surana, is with us. So just a quick couple of thoughts from him. Mr. Surana, thanks so much for joining in. We spoke to Moody's earlier on in the day and asked them about the rationale and the impact that this could have. One, of course, embedded in the review of this upgrade is their assessment that crude will stay between 40 and 60, will not exceed those. So the vulnerability of countries like India to a crude price spike will not be that high, because crude will not spike in the first place. One, that, and two, your initial reaction to this upgrade that has come in.
Yeah, good morning to you. First of all, it's a good news for the country. I think it is after around a long time. I think after almost 14 years that rating has been improved. With the improved rating of agencies like Moody, definitely it helps the Indian corporates to raise the money at a cheaper rate in the international system. Also, some of the FIIs who look at various developing markets from the lens of the ratings of the country, that helps them to bring more money in the country for investment. So that goes well for the Indian stocks. And it also is a confirmation of the confidence of the international community in the various reform measures which are being taken to strengthen the economy in the country, whether it was the GST or some of the other things to the banking sector reforms.
How would a company like yours will actually benefit, if you could tell us, with the upgrade directly, because of your ability to probably raise funds as and when required from global markets, maybe at a cheaper rate, and also indirectly because of strength in domestic currency, if you could tell us?
Yeah, so strength in domestic currency definitely helps us because a substantial amount of crude oil is imported. So it helps in the import bills. At the same time, but some of these currency effects get passed on in the pricing because the pricing also is built up from the international pricing. So to that extent, it helps in the fuel and loss in the refineries, which is actually used for producing. The expenses on that reduces to the extent the currency is stronger. That's one part. Now, as far as the companies like ours are concerned, who enjoys the rating, the sovereign rating of the country, when country's rating improves, our ratings also are more chances to get improved because we almost maintain the rating of the sovereign country. So to that extent, if we raise the funds for our capex, etc., and company like HPCL has got a substantial capex plan, so I think it will be good for us.
So I'm taking it more as a representative of corporate India and
yes,
and India's Navratna companies in general, like yours, will stand to benefit by this upgrade.
Yes, that's correct.
Okay, great. Mr. Surana, appreciate you joining us. I know we can't ask you too much about HPCL, so avoid doing that, but thanks for joining us and taking the time out.
Thank you so much.
That's Mr. M.K. Surana of HPCL. No surprise there, Chakri. I mean, this is what the reaction would be from almost any company which would either have the option of borrowing overseas or be linked to the country's rating agencies as well. No surprise at all. This would probably hold true for almost all corporate.
Indeed, and just like Mr. Surana mentioned, and that's exactly what we were alluding to earlier about and improvement of profit margins. Because even if a reduction of interest expense or refinancing of debt will translate into higher profits and higher profit margins, that translates into higher overall profitability. And therefore, if you look forward, now instead of FY 18-19, if you go FY 20, because if you are at the beginning of a growth curve, then multiples start looking a bit more normalized.
Okay. Mr. Kara, a question really on the investment cycle as well, because embedded again in Moody's statement, they gave out that any further upgrade, if at all, that may come in or if may not come in, whatever, would be dependent on a couple of factors. One is the fiscal math and any deterioration thereof. Now the FM has hinted towards maybe sticking to the glide path but not sticking to specific numbers. But I want to talk about the second part of the Moody statement, which is that any upgrade will depend, one, on the fiscal math, but two, on how soon the investment cycle revival happens. Now, what is your pricing in scenario with regards to that? Because as things stand, if you look at corporates, we spoke to L&T the other day, there is no immediate sign of that picking up and picking up in a hurry.
I agree with you. See, I think as far as the capacity utilization of most companies are concerned, corporates, I think they are still struggling on capacity utilizations, and so the earlier capex cycle has still not yet been reached maybe 60-70% capacity utilization for corporates to think of going for more capex. A and B, there is a huge amount of non-performing or capacities which are available for sale at various forums. So I'm sure corporates which have the wherewithal to be able to buy into that would first prefer to buy that rather than going for fresh capex. So I think the capex cycle, as Mr. Subramaniam of L&T also alluded in that interview, I think it's still maybe 12 to 18 months away before you see the capex cycle picking up. First, capacity utilizations have to move up, which is still, I think, 12 to 18 months away.
So you would expect investment cycle indeed to happen at a much later date.
Absolutely.
So then put all of this into perspective. What does this mean for an average equity investor? Or what does it mean for a large client of yours that you would be advising to? From the levels that we are sitting at, based on all the theses that you have, including earnings recovery, what do the markets do?
So in terms of return expectations, because we have had a very good run in the last 12 to 18 months, the returns will be more reasonably back-ended. That is one thing that we will have to appreciate. A and B, also the return expectations have to be much more reasonable, and past performance should not be taken as an indicator of how things are going to move forward. So that's one way to look at it. But I would say that within that, as portfolio managers, I think they always move the portfolio from between growth and valuations, and there are various sectors where valuations are reasonable, possibly there is under ownership, and we have seen some kind of an outperformance happening in those sectors. I specifically look at the way IT has performed. You had TCS, I think, hitting a 52-week high despite all the headwind in the IT sector. So clearly the market is indicating, and you have also seen some other mid-cap IT stocks which have done very well. Now at one level we are talking of headwinds in that sector, and then you have the industry leader over there reaching a 52-week high, and then so many of the mid-cap IT companies doing well. So I think investors or professional fund managers will move into areas and stocks where they possibly see valuations in their favor, and accordingly will try to outperform the benchmark indices. So that's the way things going forward. So you would possibly see a great run as far as improving returns or improving performance from FMCG companies, but the valuations, etc., possibly are not in their favor. So we believe that investors need to be cognizant of the fact that we are in a bull cycle. We have had a very good run. Things are improving, and returns will be positive, but it should be more gradual than a bump up immediately.
So when you want to get into some of these value stocks, what are those pockets in the market where you'll be trimming your positions probably to create some space for these new ones?
See, as I said, FMCG companies, etc., the valuations for the growth that these companies are showing, and I think they are very expensive from a 2-year, even from a 2-year perspective. We're possibly talking of 40-45 times earnings for many of these stocks. So obviously, they will continue to perform well, but from here to make any significant returns over there will possibly be not possible. So that's one segment which looks expensive. We have already seen a correction happening in many of the NBFCs where the multiples in terms of price to book, etc., have been on the higher side. I'm not saying that any of those businesses are under challenge. It's just a question of they have possibly discounted 2 years in advance, and they will go through a natural consolidation process, possibly some macro news in terms of maybe the cost of money, etc., going up, etc., is also coming up. So you will have some reasons, and you will see money moving out from there. And where is that money going in? Possibly we have already seen a decent amount of money moving from there into your public sector banks, where there are tailwinds now which have been created. Now, fundamentally, do we believe that public sector banks will do very well over a longer time frame? Possibly no. But from a next 2-year perspective, do they offer a good opportunity for investors to make money? Yes. So I think fund managers are smart enough to move money into stocks and sectors where they see more visibility or better returns in the next few years. I think what we have seen in telecom is a classic case again. Possibly Bharti bottomed out on the day Jio launched. And after that we have seen, and that's a clear-cut indicator of how things move.
Well, that's interesting. Great, gentlemen. Krishna Kumar Karwar, Chakri Rokpriya, thank you so much for taking the time out and being with us today on Bloomberg Quint. Really appreciate your time and your views.
Thank you. Thank you. Thank you very much.
All right, that's the view from two experts and big ones at that. The markets is making a big move to about 1% higher. The Nifty Bank, Pradeep Pandya, you were on the button at all-time highs, 1.5% higher. The question mark is, the question mark is whether it can do more. That's, I mean, it
should, because normally now what you call a blue sky zone. So normally you'll stay at this level. We'll probably see more short covering after a while, and should be able to sustain given this kind of news, and also the fact that we have corrected over the last 2 weeks or so, which means there should be some space in the long portfolios. I mean to say traders to take some positions.
I will be really surprised if we don't move higher from where we are. But remember, we don't make predictions. It's just a gut feel that you have on a day like this, that it seems to be a trending day. We may have just more green on the screen. At least don't think we'll succumb from these levels.
Definitely. So day before, when we were kind of trying to see if markets had reached the bottom, look at the change in scenarios.
Well, maybe charts do tell a story. I'm turning a believer. Pradeep Pandya is converting me into one. But for now, they'll take a very quick break. Up next, will we talk about what's really happening to corporate India? What would be their reaction to news like this? Get in one large company, Astral Poly. Hiranand Savlani of the company will be joining us on the other side to talk about this.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Business news, we're news for business people.
Okay, welcome back with us on Indian Open. About 1% higher for the Nifty. The Nifty Bank is the one which is piling on the gains. But what we are trying to do, aside of getting you market reactions, we've gotten you a slew of reactions already, is trying to get you corporate reactions as well. Leaders within the specific pockets. Let's get in one more voice there. Astral Poly, there are multiple things which will happen. One, of course, the numbers. The volume growth was very, very strong for Astral Poly in Q2. The question mark is, with all that's happened in terms of ratings upgrade for the country, and therefore the cost of borrowing for certain companies might come down. There is also this tailwind to affordable housing. So there's so much happening within this pocket which could impact a company like Astral Poly, which is anyways a leader in the segment that it operates in. So let's get in Hiranand Savlani. He's the Chief Financial Officer at Astral Poly, joins us right now on the show. Good evening, Mr. Savlani. Thanks so much for joining in. A quick thought firstly on this upgrade that has come in. We're talking to companies in India Inc. and trying to gauge a sense of what does this do to borrowing costs. Now, would you as a company have any aspiration of raising money in the offshore market, and therefore this rating upgrade by Moody's, does it impact that for you as a company or for companies within your space which may be looking to do the same?
You see, our country has got upgradation for almost after 14 years, I think, which is one of the best news this country can get after so long time. And corporate Inc. should be zooming today that after such a long waiting, our country has got upgraded. And one more good news for our sector today also being announced, that is the extension of limit square feet area of a housing and extension of subsidy. That is one of the best, I can say, we can be benefited, because India needs millions of houses. Like if you see the CLSA report, they are expecting India need 50 million houses in next 5 years. So if these kind of announcement will be there and the borrowing cost will come down, I don't think we can expect more than that. So we are very, very excited today with this news, both from our industry point of view and secondly from the country point of view. And we are also growing company continuously. If you see, we are continuously last 10 years, if you see, we are growing at a 20% plus CAGR in volume terms. And in terms of return to our investor, we have given 50% CAGR return to our investor in last 10 years. So a growing company always need a money for the growth. So if we are getting the money at a lower cost, I think it will be a big advantage to the company.
Would you, as a company, look to or need money in the first place, and would a move like this help you in indeed raising money in the offshore market?
At least near term, we are not looking for raising any money, but if we have some good projects in hand, we can definitely plan for that. But at least near term, we are expecting a sizable cash flow to our company. Then we may not require, but growing company can need any time money. So it's very difficult to quantify that when we will be required that money.
Okay, Mr. Savlani, now shifting focus to Astral Poly, just a few questions, quick ones at that. Firstly, your volume growth in the plastics segment was very strong. That helped you beat estimates by a margin. How is business shaping up for you? And if Q2 was indeed this, and there is a strong tailwind to affordable housing which is provided. Yesterday we had some other moves that the government has given in terms of the carpet area increase for the MIG1, MIG2. How does all of this augur for Q3, Q4? But more importantly, these seem to be long-term moves in nature. How does this augur for FY19, possibly FY20?
I think all this move are going to support the company, but that cannot be on an immediate basis. That I can't say you that in Q3, Q4 we will be getting the benefit out of this announcement. But you are absolutely right that on a long-term basis, company is going to be benefited in a big way. And you see, last 4 years, construction activities in our country is very slow. And in spite of that, our company is able to deliver 15% volume. So we are very positive for all this announcement. And going forward, maybe next year, FY19 onward, we are expecting that will be a sizable growth in our sector and to our company also.
Okay. As a result of this, and your EBITDA margin performances were very impressive. What does this do to your internal assessment of what FY18 could look like? I mean, has that dramatically improved post Q2? Because I can understand Q1 would have been iffy for most companies, maybe not for you, but iffy for most sectors with all that was happening. Now that GST has settled down a bit as well, how is Q3, Q4 looking like?
I think Q3, Q4 also will be good, but polymer prices are always up and down, so very difficult to predict. But we are quite confident that historically, if you see, the first quarter is delivering 45 to 40% kind of revenue, and second half is delivering 55 to 60% of the revenue on a full year basis. So economy of scale will be there in the second half, and history says that second half is always better compared to the first half. So we are expecting that we should be delivering a good number. Now coming to the FY19, we are doing the expansion to take the advantage of logistics. So we are adding up one plant in Rajasthan, which will be ready by February, where we are adding the 20,000 metric ton capacity, and plus we have additional space available to add another 30,000. So total 50,000 capacity will be there, but the first phase will be 20,000 metric ton. So with that, we are going to take a lot of advantage of logistics in the northern market. And you all know that in the plastic pipe industry, logistic costs play a very, very important role. So for us also, in a PVC category, the logistic cost is running between 5 to 10% kind of value. So will be a big advantage to us. Secondly, our south plant, which is right now working at a 90% plus capacity. We have a 20,000 metric ton kind of capacity. There we are doubling the capacity, and we are expecting that that plant will be up by April. So with these two new additions into the plant, company is expecting that we will be saving sizably into the logistics side. Plus, right now the compounding activity was focused only to the Gujarat location. Now we are decentralizing that also. So compounding logistics will also going to play. So we are very positive and optimistic about next year's margin expansion.
Okay, I have one final question, and that is, how is the outlook looking like for the not just for the immediate future, but for the times ahead? Because let's face it, I mean, one, you expanded capacity at various pockets, including Hosur and Gelot and a few other pockets. About a year and a half ago, and please correct me if our timelines are wrong, but you entered into allied segments, adhesives, for example, which is a natural fit maybe to the kind of market that you cater to. What's the compounded annual growth rate, if I can use that term, that you would foresee for Astral Poly as a company, leader as it is in the segment that it operates in, over the course of the next 3 or 4 years? I'm not giving you a timeline for 6 months. I'm actually asking you to project what Astral Poly as a company could be in 3, 4, 5 years' time.
I think if you take it conservatively, we should be growing minimum 15 to 20% volume growth for next 5 years. And our expectation from the adhesive business is very high. The reason is very simple, that we have a very low base into the adhesive. We have very limited product categories into the adhesive. Now we are adding a lot of new products into the adhesive category. Secondly, we have doubled the capacity of adhesive plant in Gujarat, and which is going to help us again in the logistics side also, and again the new product launch also. And a lot of new products are still there in the R&D stage also, because we are taking a lot of support from our UK company into the R&D side. So we are expecting next 3 to 5 year horizon, we are going to launch a lot of new products into the adhesive category. You can see when we acquired this company, our margin was just 7% EBITDA. We have already taken our India operation last year to 16%, and this year also we are expecting that it will be little more than the last year. So overall, I can say that we are very, very positive about Indian market, and particularly the segment in which we are. So 15-20% volume growth should not be the problem to our company for next 5 years.
Wow, that's tall. You're saying conservatively 20%. There is an outside chance that the numbers, compounded annual growth rate over 5 years, could be higher than that as well.
Yeah, but see, why we have to be conservative? Because still Indian economy is not growing what we are expecting, and particularly our sector, the construction side. So we are expecting now the ready inventory is reducing in the system. So there are high probability that the new construction activity will start picking up maybe 3-4 quarters down the line. Secondly, one good thing is happening, that because of this RERA, the small developers will be wiped out from the system. So only large developer will be there. And we are quite confident that the large developer will stick to the organized play only. That doesn't mean only Astral. There are other companies also, but they will be sourcing their requirement from the large player. Secondly, under RERA, developer has to give the guarantee to the consumer for the 5 years. If anything goes wrong, they have to get it replaced from their cost. So because of that also, they will not be going to the generic brand. So they will be stick to the quality player like Astral. So all these things are going to take play over a period of time. But at the same time, we don't want to communicate that from the next quarter onward or maybe 2 quarters down the line, we are going to grow at a very rapid pace. But yes, we are quite confident that once this thing will settle down, maybe it will take 3 quarters, maybe it take maximum 4 quarters. Then the construction will start picking up. And history says that whenever the construction activities start picking up, it takes at least 5-year time to reach at the peak. And that is what we are expecting. So let us wait, keep finger crossed, things will be all right, maybe few quarters.
Okay, Mr. Savlani, we'll leave it at that. Thanks much for taking the time out and joining us and giving us that perspective. That's Astral Poly. Well, fairly hopeful of recovery being meaningful. By the way, commodities have bounced back today as well. Or rather, it's not commodities which have bounced back today, but just that the commodity-led stocks are amongst the principal gainers in the session today. So Vedanta and Tata Steel are 3.5% higher, so good moves there. Look at ICICI Bank, that is up about 3.5%, so that's not doing too poorly for itself. State Bank of India is about 3% higher, so that is doing okay. Bajaj Finance is about 3% higher, so that is not doing too badly either. For viewers who are tuning in right now and just wondering as to why is it that the market is in such a good mood and the Nifty Bank is at new highs, let's get in some of the quote plates. Some tweets that have come out from government officials and otherwise. Moody's has upgraded India rating. I'm sure most people know about it, but to stable. Now, a whole host of reactions that have come in, and we'll get some of these on the screen for you to tell you how have different people reacted. A lot of people have spoken to us earlier. A lot of government officials have tweeted about these things as well, including Piyush Goyal, including Hasmukh Adhia, and the PMO as well. But this is what has happened. Moody's has upgraded India to Baa2 from Baa3. The outlook has been upgraded to stable, which is a fairly good thing. And keep in mind that this is not a change in outlook. This is a rating upgrade that has come in. Meanwhile, as we speak, just keep an eye out on the flashes as well. HDFC Standard Life has settled at a price of 331 versus an issue price of 290. So that new listing will start off on a fairly decent note. On a day like this, you probably want IPO investors also make money. So just keep that at the back of your mind. This is HDFC Standard Life settling in at about 310. In about 15 minutes, or in about 10 minutes rather, you will have the HDFC Life management, of course, address the media as well and bring in the listing. So that is something that we'll take up in the FNO show. But I was talking about the reactions that have come in from India Inc., from market participants, and we'll get all of those quote plates going on the screen as well. We'll also tell you what the different government officials have tweeted about, including, as I said, Piyush Goyal, Hasmukh Adhia, and a few others. But this is Hasmukh Adhia's tweets, and of course, he's saying that the rating agencies too are recognizing what the government has done, and therefore that is very, very welcome. This is what Dr. Hasmukh Adhia had to say. This is the reaction, the separate set of reactions that we've gotten on various markets. So it's not just the equity markets which are reacting. The rupee market started off on a positive note, about 1% higher. The trending in the currency was about 1% higher, which was actually pretty good. This is the State Bank of India chairman talking about how the Moody's upgrade is an endorsement of India's inherent strengths. Moody's recognizes India's structural and institutional reforms. That is what the DEA secretary is saying as well. And it's a party that government can have, because this is frankly an endorsement of what all that the government has been trying to do. I know there have been various question marks, and rightly so, that have been raised about the slightly slipping fiscal math that we've been witness to as well. The FM was, in fact, at the Morgan Stanley conference saying that there may be a chance that while the glide path remains the same, there could be a change or a rethink into the fiscal math and the targets in the immediate term. I think that's what I read of that. I'm not quoting it verbatim. But he did refer to, of course, the glide path remaining. But the key thing is that Moody's has gone a step forward and taken a forward view of India and said that we are taking into account the reforms that the government has made, and therefore believe that there is a case for a ratings upgrade. I'm just recounting what Ira told me earlier on in the day, that Moody's has trended to be a lot more kinder to India than what S&P and Fitch have been. So Moody's is first off the block in taking off the forward view. We need to see if the other rating agencies follow suit. If not immediately, then over the course of the next 2 or 3 odd months, maybe budget does it for them. Let's wait and watch. The more interesting comment came in from Jayesh Mehta. I think Jayesh Mehta of Bank of America Merrill Lynch had to say that this puts the pressure on government to make sure that they stick to the path of fiscal consolidation, because now that there is a ratings upgrade that is coming, the onus is on the government to ensure that, one, the structural reforms stay in place and of course bring some results, but two, also as to what does this do to the fiscal math as well. So all of this is very, very important. Amidst all of this, I think in moments from now, we'll also get in Darshan Mehta, our head of research, to tell you what CLSA had to say in their note. It is independent of what Moody said, but it's just a clutch of names or a clutch of things that have happened which have led to this positive buoyancy in today's session. CLSA had the big conference in Delhi over 2 days, and CLSA had to say that they are very bullish on India, and they didn't take into account this ratings upgrade in the first place at all. So that is something that you need to take cognizance of. Darshan will join in and speak about that too. So that's another feather in the cap, quite frankly. Credit Suisse India strategy came out as well, but I think the CLSA note is of cognizance, and we'll tell you about that as well. Last but not the least, just want to mark a few stocks that have moved around just before we get in Darshan to speak about that note. But just want to mark a few stocks that have been moving around in the session today. Kolte Patil is up a whole 12%. Indiabulls Real Estate up 5%. Godrej Properties up 4.5%. I think real estate is that big mover in the session today. Okay, a very special voice, I'm told. Nilesh Shah of Envision joins us right now on the show. Nilesh, good morning. Thanks so much for taking the time out and speaking with us at Bloomberg Quint. Really appreciate your thoughts, Nilesh. Almost everybody that we've spoken to over the last 2 hours, Nilesh, say that while this was anticipated, the timing has taken them by surprise.
Neeraj, and to all the viewers, clearly this is a historic step, a historic signal from international rating agencies, and clearly it reflects all the structural reforms that this government has undertaken, and I think it augurs really well for India, for Indian economy. I don't think one can really kind of, in a way question the timing or be surprised with it. This was something which was in the offing for a very, very long time. It's been a strong case which the Indian government has been making with the rating agencies in terms of a case for an upgrade. And I actually believe that this is honestly a very belated call on the part of the rating agencies. But nevertheless, I think it's a very, very strong message and a strong signal.
Okay, Nilesh, this signal, nevertheless, what does it do to markets per se? And this is just a judgment that I think each of us or all of us will have. But we are perched at all-time high levels. But there are tailwinds of reforms that might come into place. Earnings has started looking like it is going to pick up. And one of the three large rating agencies has turned the view around. Does this mean that even if there are not immediate strong upsides, the downside levels may be capped?
Well, Neeraj, I think, yes, I agree with you that this specific rating upgrade may not mean much for equity markets in the very near term. All that it does is it just provides some kind of a cushion to a downside in the very short term. Because what markets
Nilesh, just request you to stay on. Arvind Subramanian speaking. Let's get across.
Perhaps a bigger jump given the scale of the
I think they do what they do. We have to do what we have to do.
They have also said, sir, in terms of fiscal consolidation, they will watch out for the path going forward. In December, we have to review the fiscal math and the numbers and the borrowing program. Do you think now those considerations will play on the minds of Finance Ministry again?
As I said, this is a welcome development, but I think government policy is dictated by what we have to do in terms of our own objectives, macroeconomic reform, reviving growth, all of these things. So that's going to be very important.
So do you think FIS has been encouraged by one last question on perhaps potential downward risks on account of the banking sector's health? They've red flagged that. Just a word on that, sir.
No, so the government has taken action on that, right? I mean, government has recognized the problem, and I think one of the big things government has done is the recapitalization plan, which is a recognition that a problem needs to be fixed. Thank you.
Thank you so much.
Thank you so much.
Okay, and he spoke to us earlier on in the day as well, and I think in response to Ira's question, pretty much said the same things. But Nilesh, we were in a conversation, sorry, but just had to cut across to the Arvind Subramanian. But you were making this point about whether if it doesn't mean too much of an immediate upside to equity markets, does it provide a cap to the downside, if at all?
In a way, it does. But obviously, this ratings upgrade is not going to be any substitute for earnings growth, and I think that is going to be the most important development which equity markets will watch out for in 2018. But having said that, what this rating upgrade does is it could potentially lower the cost of capital for Indian corporates, which in turn could drive earnings. And I think it could provide a lot of momentum to growth in the future.
Okay. Nilesh, I'm told you're on a tight schedule, so we'll leave it at that, but really, really appreciate you taking the time out and joining us for this quick perspective.
Thank you so much, Neeraj.
Thank you so much, Nilesh. Okay, that's an important market voice, Nilesh Shah of Envision Capital. But with that, we come to an end of this edition of First Word for sure. Keep in mind the Nifty Bank, an eye out on the Nifty Bank, and I'm sure the FNO show will talk in detail about this. But the Nifty Bank is now perched at 25,900, 1.8% higher. It started off well and has only moved up even higher. So I'm sure the FNO show will take cognizance of that and talk a lot about what trades out there could mean. A new kid on the block, and a large one at that, HDFC Life, also set to list. So we'll wrap up this show. Up next, the FNO show. Do stay tuned.
Are we live?